particularly around election outcomes.
Yeah, so I think Amy said something that's important about how stocks basically are meant to represent their cash flows and then finding a valuation discounted back. But the missing ingredient to that statement is the role that sentiment plays in the short term. And I agree, Scott, with the point that you're bringing up being important. And the surveys actually reflect that. There was an institutional investor survey last week that found more professional investors, asset management firms, et cetera, more of them are concerned with the coming election than are concerned with the virus, which is wild. But that is, I think, the next big sentiment-driving catalyst to come, and I think it's going to be profoundly negative. So in the short term, I do think we'll have chaos. I absolutely think that it's going to be a long, drawn-out fight, even if it's clear that Trump wins the Electoral College, which I don't think it will be. I don't think Biden will be in a rush to concede. Al Gore didn't concede for 6 weeks. And what was different about that period of time in 2000 versus today, in that period of time, neither candidate was an incumbent. Now we have an incumbent who is publicly saying things like, the only way I could possibly lose is if it's rigged. He's already planting the seeds. He has absolutely no intention of leaving if he loses. We should take him at his word. And so I think it could be very ugly and it could drag on for way longer than it did in 2000.
So you don't think it's priced in?
I mean,
Jim thinks it's priced in.
No way. And with an incumbent involved, it gets even more complex because the president has powers, and Bill Barr has powers, and Mitch McConnell has powers, and they have demonstrated that they will use those powers to keep their guy exactly where they want him. So I would say it's not priced in. Now, here is the countervailing force that I think ultimately will stabilize the market. And by the way, we don't trade on politics. We don't invest based on who's going to be the president. And all the capital gains and corporate tax stuff you hear is nonsense. Ronald Reagan raised the capital gains tax from 21 to 28% in 1986. The stock market continued to boom for years afterward. Forget about all that stuff. The chaos will be sentiment-driven more so than it will be fundamentally driven. But the countervailing forces that will help us are twofold. First, we will absolutely have an FDA approval on a vaccine at some point during that window of electoral chaos. That's A. And then B, buybacks have fallen off a cliff this year. I don't even think people understand the extent to which that leg of the stool has disappeared. We never talk about it. Buybacks were at an annualized rate of almost $1 trillion for 2020 in the midpoint of the first quarter of this year.
Okay.
And they have vanished. We're doing less than $100 billion worth of buybacks in Q2.
Good.
I doubt that materially changed much in Q3. Buybacks will return. And so the large cap techs that we talk about being important to the market as stabilizers, that's where that return of buybacks will show up. I think we'll be okay.
I want to interrupt you. Forgive me for interrupting you, but you make a good point. And on that point, I want to bring up some information that we have about buybacks and about capital return plans and ask you all what you think about it, because a number of major companies have said they are resuming buybacks and or dividends recently in September. And we're rolling the list here as they roll by. Brunswick and Darden and Dick's Sporting Goods, Dollar General, Dollar Tree, Dunkin' Brands, Foot Locker, Guess, Johnson Controls, Kimberly-Clark, Kimco Realty, Lululemon, MetLife, raising dividends recently, General Mills, Microsoft, Verizon.